Consider this. A company once known for slow growth and underwhelming 10-year returns now bursts ahead with 67% gain in 1 year alone. That's the story of ENGIE. But it isn't just about numbers. It's about transformation. Moving from old fossil fuel routes into the fast-growing world of renewables, storage and clean power contracts. In this video, I'll explain how this transformation is playing out and why nuclear power still matters. And today's analysis has been requested in the comments by Ketzaplias2003. So thank you very much. This was indeed a very interesting suggestion. And if you're new here, my name is Florian and I'm a physics engineer from Germany that has been investing for almost 25 years already. Welcome to the channel and thank you for joining me today. So in the last 12 months, ENGIE could deliver 67.5% total returns and easily outperform the broader market with this. But this recent good performance came after a generally very weak decade. With only 164% total returns in the last 10 years, their long-term performance was only roughly half of that of the S&P and only around double the returns from the last 12 months alone. Of course, we will look into the reasons for this in just a second, but first, let's also see what ENGIE even does. ENGIE SA is a French energy consortium that is active across electricity generation with natural gas, renewables and nuclear reactors. With 3 segments in their core business, ENGIE covers the full energy value chain, from production to infrastructure and supply. In the last years, the company has been making a strategic transformation from traditional fossil fuel towards low-carbon energy solutions like wind, solar, biomethane and hydrogen. But they also cover related energy services like the optimization of generation and storage, or the risk management for cities, industries and buildings. For investors, ENGIE actually gives an interesting mix between legacy utilities and the fast-growing clean energy transition that is the current focus for them. This strategy is still fairly new and the company has made huge efforts to build up the infrastructure for distribution and generation of renewable energy since 2020. And even though the political climate all over the world and also in Europe has recently shifted away a little bit from renewables, ENGIE is still following their strategy. And over the last years, this was pretty successful. The growth of their NRIG, their net recurring income group share that the company uses as a key financial measure, has increased pretty significantly. But the majority of this growth came in the years 2020 to 2022. Since then it has slowed down again. But they could still build up their assets like wind and solar production, battery storages, but also power lines significantly during this time. And these assets will deliver a steady yearly income from here on out. Recently, there have been some interesting developments that could again speed up their growth. First, after a policy shift in Belgium's energy regulations, ENGIE has started 2 nuclear reactors in the country. In 2022, Belgium delayed the planned nuclear phase-out by 10 years. But that's not all, because earlier this year, these phase-out plans were stopped completely. Now, the 2 plants that are run by ENGIE provide 40% of Belgium's power and are the only 2 nuclear power plants that are operating in the country. These 2 plants are also the only 2 nuclear power plants that ENGIE currently operates, and the company is also the only operator of nuclear power in the country. So it could be speculated that nuclear power could play a bigger role going forward. The company itself doesn't expect this though, and they think that the contribution of these nuclear plants on their EBIT will decline to basically 0 in 2027. Most of the numbers in the report are also stated without the contribution of nuclear for the time being. So if this changes, it could represent a significant upside for them. But there is no clear indication that this will happen soon. But it also means that this is not yet included in the growth forecast for the next years. And between 2021 and 2027, the company thinks that they can grow their EBIT with a CAGR of 10%. But we also see here that most of this growth again came between 2020 and 2023. In 2025 and 2026, this should be roughly stable and on a similar level as last year. Also interesting to see is that the growth from here on out will come to a larger part from new investments, while declining energy prices in France and Europe are the largest headwinds for them that are pushing their EBIT down from 2024 levels. So all in all, their growth in the next 2 years will most likely be a bit slower compared to what we had in the last years. But with the focus on renewables, the company has also increasingly focused on signing PPAs, power purchase agreements, with their customers. These PPAs are basically contracts between the power generator and their customers that are usually long-term and provide a fixed or indexed pricing. One very recent example for this is the agreement with Meta that will buy 100% of their Swenson Ranch solar farm as soon as this is ready to begin providing power, probably in 2027. This is actually pretty huge for renewable utility providers such as ENGIE. Because, as McKinsey points out, these agreements are a catalyst for the development of renewables in the first place. Especially PPAs for 24/7 power that requires not only the power production, but also the long-duration storage, essentially batteries, are in huge demand. And it is probably not surprising to you that this trend is driven by our hyperscalers and their need for cheap and reliable energy for the data centers. And these 24/7 clean power trends, secured through PPAs, are precisely where ENGIE has concentrated its strategic efforts since 2020. So they are in a great position to reap in the benefits from this. It also had the nice side effect that the part of the EBIT that is fixed by long-term contracts has vastly increased. From 42% in 2024, it is now up to 63%. So over half of the EBIT today already comes from fixed contracts, which gives them a very secure and plannable income. If you've been following me for a while, you probably know that this predictability and the safety that comes with it is something that I like very much in my investments. And I would only expect that they can further increase this over time. Because despite the shift in policies that made it a bit tougher for renewables, the general market for this is still growing. Right now, the IEA, the International Energy Agency, still sees a growth of almost 6% per year for renewable energy generation until 2030. And the broader energy transition market that includes the electricity generation, but also the power transportation and infrastructure that is also part of ENGIE's business, is expected to grow with even more than double this growth. Fortune Business Insights even sees a huge market growth of over 15% annually here. So, now that we understand their business, their growth perspective and the market, let's also check their financials and rank them with my stock scoring system. And a look at my fundamental dashboard in TradingView confirms what we also already saw in their company presentation. Most interesting here for a utility company such as ENGIE is the EBITDA and the free cash flow. And we can also see here that these metrics are generally recovering after a huge decline and pretty weak numbers from before 2020. So we see again that their new strategy and focus on renewables and energy infrastructure has helped the company immensely. The revenue can generally fluctuate with commodity prices, sales volume, and even regulatory changes, so it doesn't always accurately reflect the business of a utility company. It is still nice to see that it has recovered from the lows in 2020. But still, the growth score in my scoring system is only pretty average, which has also to do with the slow growth in the last 10 years. And as the company itself predicts, the growth, at least for the next 2 years, will also be rather slow. So they only get 5.2 points for 5 years and 4.9 for 10 years here. Their balance sheet is also very reasonable with an interest coverage ratio of 2.9. Unfortunately, it seems that TradingView doesn't have the information on their debt levels though. But a brief look into their last earnings call from their third quarter that they just released last week reveals that they are currently sitting on a net debt to EBITDA ratio of 3.2 times. This is actually pretty good for a utility company, although it is a bit above my threshold for my investments in regular companies of 3 times. Where the picture gets a bit more mixed are the margins. While these are roughly in line with other European utility companies, they are below the margins that some US utilities have. What is nice to see though is that their cash from operations, here the red bars, have significantly increased in the last 2 years. far more than the free cash flow the orange line would suggest. And that is because the company has also dialed up their investments during the same time, as we can see here. So while their free cash flow increased only a little bit, they used the money to fuel their future growth. My stock scoring system is optimized for regular companies, so unfortunately it doesn't reflect utilities too well yet. This is something I want to tackle next, but for the time being it compares these numbers with regular companies. That is also why ENGIE only gets mediocre scores here. But even when we only compare it to other utility companies, which we'll actually do in a minute, I think that the score would be a bit better, but not because of the margins, but mostly because of the decent debt ratios, long-term debt to EBITDA, and the decent interest coverage that are quite good for a utility company. Where ENGIE really stands out though is the dividend score. Here they get a clean 10 score for yield, growth, and their payout ratio. This gives them a score of 9.25 for both timeframes. So my scoring system actually gives them a much better score here than Seeking Alpha, for example. And that is because Seeking Alpha calculates this in dollar. So they also include exchange rate effects here, which is just wrong from my point of view. That is also why they only state 2 years of dividend growth here. But when we look at the company's homepage that lists their dividend in their home currency, the euro, we see that it was actually growing pretty much over the last 5 years. And we also see that the company gives us the option to get a 10% bonus on the dividend by registering the shares. This can be done with the form that they provide here. I will leave the link to this form in the description below. And if you are already a shareholder of ENGIE, I would say that it makes sense to do this. Because if done right, there is basically no downside to this, but you get an additional 10% bonus on your dividend, which should not be neglected with the already very high yield that ENGIE provides. There are basically 2 ways to do this. The first is to convert the shares at your broker to registered shares, which is what I would recommend, because then you can basically still trade and sell these shares at your broker as usual. The second way is to transfer the shares to Société Générale, which is ENGIE. But then you also need to get in touch with them if you want to sell this, so it adds an extra layer of complexity and also makes the process slower. But this also only makes sense if you plan on keeping the shares long term, because you will need to be registered for 2 full years before receiving this bonus dividend. The quality score actually also speaks for holding the shares long term. Here we also have pretty good scores, and only the manager quality is below average, mostly due to the low ROIC. Overall, the company still gets a score of 7.5 for 5 years and 7.25 for 10 years here. The very good recent performance of the stock has also pushed the valuation and momentum score. They get very high ratings for momentum here. The valuation is a bit more mixed, and especially the price to free cash flow ratio is quite high. Still, ENGIE gets a decent score of 7.5 for 5 years and still 7.05 for 10 years. Overall, this leaves them with a total score of 6.4 for 5 years and 6.2 for 10 years. This is noticeably stronger than Enbridge's score from my analysis last week, and even more so compared to the small cap utility Energiekontor, which I am still holding in my portfolio. And analysts are also pretty bullish for the stock and give a strong buy rating. But the average 1-year upside is only 3.9%, so not too huge. But again, there is not much growth expected until 2027, so this seems to be about right, especially after the already very good performance of the stock this year so far. So last but not least, let's also compare them to their peers. And if you like the video so far, please hit the like button and subscribe to the channel to not miss my next one. I am trying to provide high quality research here that goes beyond just looking at the pure numbers. But this kind of research is pretty time intensive. And a small like or subscribe goes a long way to help to push this video to more people. So thank you very much. For our peer comparison today, I choose E.ON, NextEra Energy, Iberdrola, or however you pronounce this, and Enel. So the only US company here is NextEra Energy, and I choose them because they are one of the biggest utilities in the US and because I also own the stock. And over the last 10 years, NextEra also had the best total performance from this peer group, while ENGIE actually comes in last here. But this changes when we just look at last year. Here the picture is reversed, with ENGIE on top and NextEra Energy in last place. Dividend-wise, ENGIE has actually the largest dividend yield right now, and they could also grow it the quickest in the last 3 and also the last 5 years, as I showed you before. The dividend growth is just matched by the Spanish company Iberdrola. And this comes also with the lowest valuation of this bunch. Only the price to cash flow is way above the one from the others. Growth-wise, we need to look at the EBITDA and the EBIT growth for utilities, and here NextEra had actually the biggest growth in the last years. On a forward-looking basis, they are still in second place, but here Iberdrola takes the crown again. ENGIE comes in last year, but only because we are looking at the 3-year time frame where not so much happened. If we would go back 2 more years, this would change significantly. The profitability of ENGIE is roughly in the middle of the pack. But all our European companies are not too far from each other. NextEra stands out again with the highest margins here. So overall, I do like ENGIE a lot. I think they are a great and stable company, especially for European dividend investors that want to avoid any exchange rate effects on their dividends. But in contrast to most US companies, the dividend is also linked to the net recurring income. And while this should be pretty stable, I wouldn't rule it out that the dividend can fluctuate a bit year over year. This is not bad per se, because it enables the company to be a bit more generous with the dividend, but it's something investors should keep in mind. And their continued focus on stable and long-term income with PPAs should also further limit this risk. But the stock has already performed very well this year, and especially in the last 2 months. So if you're thinking about investing, it might be a good idea to wait for the price to come down a little bit more again. What I would closely monitor is the situation with nuclear reactors, because I think that a strategy shift here could present quite an upside for the company. But this is just speculation from my part, because as of right now, there is no strong indication for this to happen. But even without this, they are operating with secure year tailwinds, and the transformation from the last couple of years seems to be largely over now and gives them a great position. But as always, that is just my opinion. What do you think about the company, and are you already invested? I would be very happy to read your thoughts down in the comments. And guys, if you are interested in 3 more dividend companies that are insanely cheap right now, this video right here might be interesting for you. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.